Welcome, everyone, and thank you for coming to this workshop today as we discuss savvy IRA planning for boomers, strategies to help you save taxes and get more out of your IRA. My name is Joseph Budd, and I'm a certified financial planner and managing partner with Budd Wealth Management. We have developed and refined our client life process over the last 20 years to work with families that aspire to a work optional lifestyle. We help to put all the pieces together in the financial puzzle for our clients. Connect with us on LinkedIn and Facebook, where we post interesting personal finance content and invitations to events like this in the future. This event is being recorded, and you'll receive a link to that recording in a follow-up email. Today, we're going to talk about savvy IRA planning for baby boomers. You know, a lot of people plan for accumulating money for retirement, but far too often, that's where the planning stops. That's not good enough. The reality is that a sound distribution strategy, in other words, a plan for taking money out of your retirement accounts, is just as important, if not more so. When it comes to your IRAs and other retirement accounts, you probably have a lot of questions like, how much are my withdrawals taxed? When do I need to begin taking withdrawals? How much will I have to take? What happens to my IRA when I die? And perhaps most importantly, how can I minimize my taxes so I can spend more of my hard-earned money? You know, years ago, life was simpler in many ways, and retirement was really no different. Many people went to work, and then when they retired, they collected a pension and Social Security benefits. There wasn't as much needed in the way of planning, and people weren't all that concerned about running out of money since both their pensions and their Social Security benefits were generally guaranteed. For most people, that along with whatever else they had managed to save along the way was enough. Today, though, things are different. Companies and other organizations have abandoned pensions in mass numbers and instead have turned to 401ks and similar plans, shifting many of the risks they once shouldered onto the backs of employees and their families. Retirees are now responsible for making more of the critical decisions that will determine how successful they are in retirement. And that includes keeping up with changes to the law. For instance, the law known as Secure Act 2.0 made nearly 100 changes to the rules for retirement accounts, some of which we'll talk about today. The bottom line to all this, though, is that today, more than ever, when it comes to your retirement, you're on your own. On top of that, your retirement savings may have to last you a lot longer than you think. According to a 2011 Society of Actuaries report, over 40% of retirees underestimate their life expectancy by 5 years or more. Take a look at this chart to see what I mean. If you're a man and you're 65, you have a pretty good chance of living to at least 85. If you're a woman and you're 65, you have a better chance of living past 85 than you do dying before it. And if you're married and both you and your spouse are 65, then there's a strong chance that at least one of you will live to be 90. In fact, there's a 33% chance that at least one of you will live to be 95. That means your retirement savings could easily have to last you 20, 25, 30 years or even longer. That's probably much longer than a lot of you have considered. Put all this together and it makes having a plan all that much more important. With that in mind, one of the biggest things you can do as you approach retirement, if you're not already there, is to beef up your retirement savings by contributing as much as possible to tax-favored retirement accounts. Although contributing at younger ages is more powerful, because it gives your contributions more time to compound. You may have been able to save as much as you wanted to at that age because you were bogged down with mortgage payments, were saving for a child's education, or had other expenses associated with raising a family. Chances are you no longer have those expenses, or they'll be ending soon. And as a result, you may finally have discretionary income that can be used to fund your retirement accounts. So just how much can you contribute? Well, that depends on the type of retirement account as well as a number of other factors. Let's begin with traditional IRAs. A traditional IRA, or individual retirement account, is a personal retirement account that offers certain tax benefits. Contributions may be tax deductible, and while your money is inside the IRA, it grows tax deferred. Ultimately, when you take money out of your IRA, the amount you take out is generally added to your income. We'll talk about that more later. In 2024, the maximum you can contribute to a traditional IRA is $7,000. If you're 58 years of age or older by the end of the year, though, like most of you, then you'll be allowed to make an additional $1,000 catch-up contribution, making the maximum you can contribute to an IRA for 2024 $8,000. You can't always make a traditional IRA contribution, though. For instance, to make a traditional IRA contribution, you must have what the tax code refers to as compensation. For most people, compensation is earned income, but it also includes a number of other types of income, such as taxable alimony. It does not, however, include things like interest, dividends, capital gains, Social Security benefits, or unemployment compensation. So for most of the time, if neither you nor your spouse work, you won't be able to make a traditional IRA contribution. In the past, age was also a barrier that prevented some people from making traditional IRA contributions, but that hasn't been the case since 2019. And traditional IRA contributions are deductible unless you or your spouse are active participants in an employee-sponsored retirement plan and your income exceeds an applicable threshold amount. Those limits depend on your filing status and who is contributing to an employer-sponsored plan. Many of you probably know there is another type of IRA called a Roth IRA. Roth IRAs are similar to traditional IRAs in many ways, but there are also some key differences. One of these differences is that you don't get a tax deduction when you make a Roth IRA contribution. Once your money is in a Roth IRA, it grows tax deferred, like it does in a traditional IRA. The big benefit of the Roth, though, another key difference between it and the traditional IRA, is that Roth IRA distribution can be tax-free in retirement. If you've had any Roth IRA for more than 5 years, and you're over 59 and a half, then all withdrawals from any of your Roth IRAs will be tax and penalty free as part of what's known as a qualified distribution. Even if you need to take a withdrawal sooner, you can always take out your Roth IRA contributions tax and penalty free. Some of the same contribution rules that apply for traditional IRA contributions also apply to Roth IRA contributions. For instance, the same $7,000 contribution limit applies. Similarly, if you're over 50 years of age by the end of the year, the catch-up provision of $1,000 also apply. Roth IRA contributions are also subject to the same compensation rules as traditional IRA contributions. If you have sufficient compensation, then the only thing that can prevent you from making a Roth IRA contribution is having too much income. You can see the income limits up here on the screen. Note that if you're a single filer, as long as your income is under $161,000, you can make a full Roth IRA contribution. Similarly, if you're married and file a joint return, then as long as your income is under $240,000, you can too make a full Roth IRA contribution. While some baby boomer couples retire at the same time, oftentimes one spouse retires before the other. In such cases, you may be able to take advantage of the spousal IRA or Roth IRA contributions. These are special contributions that allow a spouse with compensation to make a contribution to the traditional or Roth IRA of a non-working spouse. In essence, the non-working spouse can use the working spouse's compensation as their own. You might be asking yourself, can an $8,000 contribution really make a difference when it comes to my retirement? The answer is absolutely. Here's a quick example. Suppose you're 55 years old and you plan to retire in 10 years at 65. The kids have flown the coop and you finally have a chance to focus on saving for your own retirement. So you make a full $8,000 Roth IRA contribution annually until you retire. If, say, you earn 6% a year, then by the time you retire in 10 years, you'd have more than $100,000. But remember, you may need to plan on living until 90, 95, or longer. So let's say that you leave the account alone and it continues to earn 6% a year. By the time you reach 85, even if you never put another dollar in after the first 10 years, you'd have more than $350,000. But since you made your contribution to a Roth IRA, that entire amount would be tax-free. Still, just think, $8,000 a year can't make a difference. And just think if you're married and you're able to make that $8,000 contribution to both your Roth IRAs and your spouse's Roth IRAs, and you have twice as much tax-free. If you're still working and you have access to one or more plans through your current employer, you might be able to do even better. While the limits on contributions can vary depending on the type of plan your employer offers, you can generally contribute more to your company plan than you can to an IRA. For example, in 2024, you can contribute up to $23,000 of your salary into a 401k, 403b, or similar plan. If you're 50 or older by the end of the year, then you can contribute an additional $7,500 as a catch-up contribution, bringing your total potential plan contribution to $30,500. Depending on your plan's provisions, you may also be eligible to receive employer contributions such as a company match or profit-sharing contribution. And as you can imagine, putting this type of money away for even just a few years can have a marked impact on your retirement savings. Plus, provided you meet the requirements we just discussed, you can make a contribution to your IRA or Roth IRA on top of your company plan contribution. How about that? Of course, at some point, you're likely to retire, and when you do, you'll be faced with one of your first major retirement decisions: what to do with the money you've accumulated in your employer-sponsored retirement plan. In many cases, people choose to roll over their funds to a traditional IRA or Roth IRA because they tend to offer greater control over one's retirement funds. They are not the only options, though, as such. Rollovers are not always the best move. Believe it or not, you may have as many as 6 different options, as you can see on the slide here, for your employer-sponsored retirement plan funds when you leave work. You can see them here. Each of these potential alternatives offer unique benefits and drawbacks. So it's usually a good idea to discuss your options with a knowledgeable professional so you can make the savvy decision that's right for you and your family. All right. Getting money into your IRA accounts is only the first half of the story. Coming up with an efficient way of taking those funds out and avoiding costly mistakes is the other half. This is far easier said than done, particularly when it comes to your traditional IRAs, 401ks, 403bs, and other pre-tax retirement accounts. In general, withdrawals from these accounts are taxed at ordinary income tax rates, just like interest. Your withdrawals are added to your income and taxed at whatever tax bracket you happen to find yourself in. If your overall income is relatively low, you may have a low tax rate for your withdrawal. On the other hand, if your overall income is higher, your tax rate will be higher and more of your IRA withdrawal will end up in Uncle Sam's hands. Here's a quick look at the tax brackets for single and joint filers for 2024. One of the troubling aspects of IRA planning is that the tax rate on your future distributions is unknown. Even if you can project your income with relative confidence, there's no guarantee that tax rates will remain the same. And while it's hard to find someone who doesn't think they pay too much in taxes now, the reality is that the top rates today are pretty low in a historical context. Take a look at this chart to see what I mean. When the income tax was first introduced in 1913, the top rate was only 7%. But within just a few years, the top rate had already skyrocketed to over 70%. After dropping back down to as low as 25% after World War I. The top rate jumped to 63% in 1932. From there, it wasn't until more than 50 years had passed in 1987 that the top rate finally dropped back below 50%, letting those in the top bracket keep more of their income than they were forced to give over to Uncle Sam. Now, of course, not everybody pays the top rate. In fact, it's only a very small percentage of taxpayers that do. That said, with our national debt at all-time highs, a budget that hasn't been balanced in years, and fiscal troubles for many of our entitlement programs like Social Security and Medicare, it's possible that rates could go up across the board. That makes coming up with the right plan even more important. To make matters even worse, your IRA withdrawals can cost you a lot more ways than just adding to your income. They can also cause you to be phased out in itemized deductions, personal exemptions, and various tax credit. They can increase your exposure to the 3.8% surtax on investment income. If you take an IRA withdrawal, you might have to include more of your Social Security benefits and income, and your Medicare Part B premiums can increase. And that's just the beginning. If you want to try and avoid these issues, then you need a plan. One way to minimize the tax impact of retirement account withdrawals is to avoid taking withdrawals altogether. This allows your retirement money to grow tax deferred and keeps that nasty taxable income off your tax return for as long as possible. You can't put off taking withdrawals forever, though. Once you reach a certain age, the law requires that you begin to take what's known as required minimum distributions, or RMDs for short, from traditional IRAs. The same rules generally apply for employer-sponsored plans like 401ks, too. RMDs are simply the bare minimum you are required to take from your retirement account each year to satisfy the tax code rules. The specific age when you must begin taking RMDs depends on when you were born. If you were 72 or older at the end of 2022, you should already be taking RMDs from your IRAs. For those of you who were still younger than 72 at the end of 2022, you will have to start taking RMDs when you turn 73 or 75, depending on when you were born. And as you can see here at the bottom of the screen, for those of you born between 1951 and 1959, you'll start RMDs at age 73. And for those of you born in 1960 or later, you'll start taking RMDs when you reach 75, unless Congress changes the rules again between now and then. A final thought before we move on. Remember that you can always take more, but if you fail to take at least the minimum amount, the IRS can actually hit you with a 25% penalty for any amount that you should have taken out but didn't. RMDs can actually get much more complicated, and as we've already discussed, the penalties for making a mistake can be pretty severe. With that in mind, let me tell you about 3 of the most common RMD mistakes people make and that you can avoid them. Remember, part of any savvy IRA plan is minimizing costly mistakes. One common RMD mistake is people make it incorrectly, aggregating their RMDs between different types of retirement accounts. For example, suppose you have a 401k and an IRA, and after calculating your RMDs for each account, they come out to be $4,000 and $3,000 respectively, for a total of $7,000. Now imagine your IRA is earning a higher rate of return than your 401k. You might be tempted to just pull out $7,000 from your 401k, leave your IRA alone, and call it a day. After all, what's the difference? They're both retirement accounts, and whether you take 7,000 from just your 401k or 4,000 from your 401k, and 3,000 from your IRA, it's the same impact on your tax return. That's pretty logical thinking, but the tax rules are anything but logical, and they specifically prohibit you from doing that. An RMD from one type of retirement account, like an IRA, can never be taken from another type of retirement account, like a 401k. Another common RMD mistake is aggregating RMDs between spouses. For instance, suppose you and your spouse file a joint return. You have an RMD for your IRA of 4,000 and your spouse has an RMD for 2,000. To make things easy, you simply take $6,000 out of your IRA. After all, they're both IRAs, and since you file jointly, the income will show up on the same return, right? While that may be true, it doesn't matter. Retirement accounts are individual accounts, and there's no such thing as a joint IRA or a joint 401k, so you must always take your own RMDs from your own accounts. A third common mistake is forgetting to take an RMD altogether. Although this should never happen, sometimes mistakes are made. It's just a fact of life. Maybe a family member is sick and you got preoccupied. Maybe you were away on your dream vacation and it simply slipped your mind. Whatever the reason, if you forget to take the RMD and you've otherwise made the mistake, the one thing you should not do is to forget about it and pretend that it never happened. In most cases, if you do that, the IRS can come back and assess a 25% penalty. One strategy to minimize the impact of taxes on your retirement savings is to avoid taking them from your IRA as long as possible. This allows your money to enjoy its tax-favored treatment for as long as possible, and it also keeps income off of your return. Which is why you've already learned not only helps keep your income tax bill lower, but also can help prevent increases in other costs tied to your income. There are some major downsides to this approach, though. Most notably, as your IRA gets bigger, so does your problem. Think about it. If your tax bracket remains at the same over time, then your IRA grows, and so does the amount you're eventually going to have to pay Uncle Sam. This is much different from other things you might be used to. For instance, imagine to buy a house for $200,000 with a $50,000 mortgage, and if the house doubles in value to $400,000, does your mortgage increase to $100,000? No, of course not. You get to reap all the benefits of the appreciation, but that's not the way it works with an IRA, 401k, or similar account. If those accounts double in value, you don't get to keep all the gains. Uncle Sam is entitled to his share. Plus, waiting to take distributions for as long as possible, your required minimum distributions later on will be larger. This could increase the impact of some of those side effects we've talked about. Thankfully, there's a way to fix this so that, to go back to the mortgage analogy for a moment, you can own your IRA free and clear, so that only you benefit from the future appreciation. It's called a Roth IRA conversion. And it's our next savvy IRA planning strategy. A Roth IRA conversion is the name given to a special type of transaction where you move money from your pre-tax retirement account, like an IRA, 401k, or 403b, to a Roth IRA. When you make a Roth conversion, the amount of money you convert is added to your tax return for the year and is taxable at whatever income tax bracket you happen to be in. For example, let's say Jill has $100,000 in a traditional IRA and would like to convert it to a Roth IRA. We'll talk more about why she might want to do that in a moment. If Jill moves forward with her $100,000 Roth conversion, she'll have to add $100,000 of her income to her tax return for the year, which will be taxable at whatever rate Jill happens to be in. Because this is a big decision and can have a significant impact on your taxes, it's always best to discuss this option with your tax and financial advisors beforehand. So why would you voluntarily choose to make one of those Roth conversions and pay taxes before you have to? Well, there are a lot of reasons, but perhaps the most common reason is one we've already discussed, to pay off Uncle Sam now so that you own your retirement account free and clear for life. Remember, with a Roth IRA, you have the potential for future tax-free withdrawals of everything in your account. If you're over 59 and a half and you've had any Roth IRA for more than 5 years, then all withdrawals from any of your Roth IRAs will be tax and penalty free for life. If you're over 59 and a half but haven't had a Roth for 5 years yet, you can still take out any of your converted amount tax and penalty free at any time. If you're younger than 59 and a half, other rules apply. Something else to keep in mind is that unlike Roth IRA contributions, there are no restrictions on who can make Roth IRA conversions. You can't be too old, you can't be too young. You can be working or you can be retired. There's no minimum amount of income you need or maximum amount of income you can have. I think you see what I mean. If you want to convert your IRA to a Roth IRA, there's nothing in the tax rules that will stop you from doing so. The potential tax-free nature of the Roth IRA may also provide you with additional benefits, such as a hedge against tax rates rising in the future. When it comes to your retirement, there are a lot of unknowns. What will the market do? What will inflation be like? What will your tax rate be? And so on. That last one, taxes, is a major concern for many retirees, and one we've already talked about a bit. A Roth IRA conversion can help manage that risk by paying taxes at today's rates instead of future unknown rates. If tax rates rise in the future, tax-free distributions from Roth IRAs will be even more valuable. Of course, if you think your tax rate will be lower in retirement, then it would be an indication that maybe this strategy is not right for you. Also, since Roth IRA distributions in retirement are generally tax-free, they typically don't impact other things tied to your income that we discussed earlier. Another big benefit of the Roth IRA, and one of many retirees find attractive, is that Roth IRAs have no required minimum distributions during your lifetime. Remember all those RMD calculations and potential mistakes we talked about earlier? They're not an issue if you have a Roth IRA. During your lifetime, you can take as much or as little as you want. You're not forced to take anything at 73 if you don't want to. That means your Roth IRA can continue to grow and compound tax-free for your heirs, which also makes it a very intriguing vehicle from an estate planning perspective. So with that in mind, it's very important that you are sure you want to convert your Roth IRA before doing so. Here are 3 questions to ask yourself before converting. Number 1, do you have a rough idea of the conversion impact on your tax bill? Number 2, do you have a plan to pay the resulting taxes? Number 3, do you have a reasonable expectation that the benefits of prepaying your taxes like this make sense in your overall plan? The answer to all these questions should be yes. Here's a savvy conversion strategy that might be helpful for you called filling up the bracket strategy. Remember those tax brackets we looked at earlier? Well, sometimes you can find yourself in the middle of one of them with room to add more income without pushing yourself into one of the higher tax brackets. For example, in 2024, the 22% tax bracket for married couples filing jointly goes from about $94,000 to $201,000. Suppose that you file a joint return and your taxable income is $100,000. That means that you could add another $100,000 of income without going into the next bracket. Making a Roth IRA conversion of that remaining amount could make sense for you. If you plan to convert a sizable portion of your IRA, this approach is often more tax efficient than converting the full amount at one time. Instead, you can make smaller Roth IRA conversions over a number of years, filling up your bracket each time. This can help reduce the average tax rate you'll pay on your converted money and may also spread the tax bill out over a longer period of time. Roth IRA conversions can be especially useful if you have a low income year. For example, if you're a business owner with unusually low sales, or if you are paying high non-recurring medical bills, or maybe you're retired but not receiving Social Security benefits, pensions, or IRA distributions. These are questions to ask to see if a Roth conversion is a good move for you. Of course, these strategies aren't for everyone, and as you can see, there's no guarantee that a Roth conversion will achieve the intended results. There's a good chance that at some point during your life, you're going to want to move around some of your retirement money. Maybe it will be done as part of a Roth conversion. Maybe it will be a new investment, maybe to work with a new advisor. Whatever the reason, you should be aware of how to move retirement money so that you don't make costly mistakes that could derail your retirement. In general, there are two ways you can move retirement money. You can either move it indirectly in what's known as a 60-day rollover, or you can move it directly with a direct rollover or a trustee-to-trustee transfer. Moving money directly is usually the savvy choice. First, let's take a look at indirect rollovers. In an indirect rollover, you receive a distribution of your retirement funds payable to you, or they are sent to a non-retirement account. Then you have 60 days from the time that you receive the distribution to get it back into another retirement account. If you miss the 60-day deadline, the distribution is taxable, and depending on your age, it may be subject to an additional 10% penalty. Even if you're on top of things and you complete the rollover within 60 days, there are other problems with indirect rollovers. For instance, if your withdrawal is coming from an employer-sponsored retirement plan like a 401k, the plan generally has to withhold 20% of your distribution for income taxes. Congress wants to make sure you don't take your retirement money, run away, and never pay the taxes that you owe. A separate troublesome rule applies to the 60-day rollover from IRAs. If you're moving your money to another IRA, only one of these rollovers can be done per year. If you try to make a second 60-day rollover, chances are the entire amount will be taxable. The same rule applies to Roth IRA rollovers. As you can see, there are some real problems with indirect rollovers. Thankfully, there's generally a better way to move your retirement money. In a direct rollover or trustee-to-trustee transfer, your money is sent right from your old retirement account to your new retirement account. There's no 60-day time limit worry about, and no mandatory 20% withholding, and there are no one per year rules to be concerned about. Typically, this is done by providing you with a check made payable to your new custodian. For example, the check might read, Company X Custodian for the benefit of John Smith IRA. If the check is made payable to your new custodian like this, your distribution can still qualify as a direct rollover and get the same favorable tax treatment. There's no 60-day deadline, no mandatory withholding. That's true even if your plan sends you the check and has you forward it to your new custodian. Another essential component of any savvy IRA plan is making sure you coordinate your IRA planning with your overall retirement, estate, tax, education, and financial plans. Your IRA and other retirement accounts can impact each of these areas, and it's important to factor those into your planning. Another way your IRA planning needs to be coordinated is with your overall retirement plan is your Social Security claiming strategy. The decision of when to file for Social Security is one that far too many retirees make without thoroughly evaluating their options first. This is a major mistake, and one that in some cases can cost you more than $100,000 of income over the course of your retirement. Now, the decision of when to claim Social Security is a very personal decision, and one that varies significantly from person to person and couple to couple. And that said, many retirement experts today believe that too many people claim Social Security too soon. Remember, Social Security benefits are guaranteed to last your entire lifetime, no matter how long you live, and benefits are generally increased from one year to the next due cost of living adjustments. Additionally, Delaying Social Security benefits past what's called your full retirement age, 66 for most of you, can allow you to earn an additional 8% increase in payments each year until you turn 70 through what is known as deferred credits. For these reasons and more, it may be beneficial to claim Social Security benefits later than you initially planned for. But you have to eat in the meantime, right? That might require you to pull money from your IRA in the interim to help cover your current retirement living expenses. Retirees sometimes opt to not do this because they say, what if I die early? If I have spent my IRA money, what takes away from my heirs, I'll have gotten little or nothing for it. While that's certainly something to consider, there are two reasons you may want to give this approach a second thought. First, a 2012 report from the Center for Retirement Research at Boston College concluded that Social Security is one of the cheapest, if not cheapest, annuity available. That might sound a little funny. After all, you don't buy Social Security, right? In a way, though, you kind of do. If you use IRA money to hold off on claiming Social Security for, say, a year, that's kind of the price you paid to get the higher benefit. If you compare that price and increased benefit to what you get from a commercial annuity provider, it's almost always cheaper. Another reason it can make sense to draw from your IRA in order to help delay Social Security benefits is that Social Security benefits are generally more tax efficient than IRA withdrawals. Remember, when you take an IRA withdrawal, the entire amount is generally added to your income and taxed at whatever rate you happen to be at. In contrast, Social Security benefits may be anywhere from 15% tax-free all the way up to 100% tax-free. So the key point for you here is that trading $1 of IRA income for your tax return for $1 of Social Security benefits will almost always leave you with a lower tax bill and more money to spend. All right, time to move on to our next savvy IRA planning strategy, and that's coordinating your IRA planning with your estate plan. In estate plans, there are really two primary goals. First, to make sure that your assets pass to your intended beneficiaries, and secondly, that they are passed to them as efficiently as possible. When it comes to IRAs, 401ks, and other retirement accounts, that's done with one form in particular, the beneficiary form. I really can't emphasize how important this form is, and yet time and time again, people fail to update these forms after major events like births, deaths, marriages, and divorces. Many times people think that because they've updated their will, everything is taken care of, but that's not so. For example, if you have your ex-wife or ex-husband named on your IRA beneficiary form, but your will has been updated to say all your assets will go to your children upon your death, guess who's getting your IRA? That's right, your ex. And I can't tell you how often this happens to people. That's why it's so important to keep updated copies of your beneficiary forms with all your other important estate planning documents. Now that you understand the importance of the beneficiary form, let's talk a little bit more about IRA beneficiaries. Any person or entity can be an IRA beneficiary, but there are different post-death withdrawal rules depending on the type of beneficiary you select. Broadly speaking, there are three main types after the Secure Act. There are non-designated beneficiaries, designated beneficiaries, and eligible designated beneficiaries. And as you can probably guess by looking at this slide, non-designated beneficiaries generally have the worst tax treatment, and eligible designated beneficiaries generally have the most favorable tax treatment. You might be thinking to yourself, well, shouldn't I just make all my beneficiaries eligible designated beneficiaries then? Unfortunately, in many cases, that's just not possible, at least if you want to make sure that specific people get your life savings. For instance, take a look at the different types of eligible designated beneficiaries there. Certainly, no one is going to hope that their beneficiaries are disabled or chronically ill. And if you don't have minor children now, it's highly unlikely you're going to have one in the future. The trusts you see there are generally only trusts where the only beneficiary is another type of eligible designated beneficiary, such as a disabled person. So that doesn't work, which leaves you with beneficiaries who are not more than 10 years younger than you are, which generally won't apply unless you're leaving your IRA to your siblings or friends and spouses. If you're married, chances are that your spouse is your beneficiary. And when the second death occurs, who will your collective retirement funds be left to? In many cases, it's going to be your adult children who fall into that middle blue category. Let's take a look close at those rules for post-death distributions for each of these categories of beneficiaries. Let's start with the group of beneficiaries that generally has the most unfavorable treatment. Non-designated beneficiaries. This group is comprised of beneficiaries who have no life expectancy and includes beneficiaries such as your estate and charity. As you can see, the rules for how quickly money must be distributed from an inherited IRA account after death depend on how old the owner of the account was when they died. In many cases, that means such beneficiaries must distribute the entire inherited account within 5 years. This can lead to big lumps of income that get taxed at much higher rates than an owner may have paid during their lifetime. Next, we have designated beneficiaries. And if you have named children, grandchildren, nieces, nephews, or other similarly close family members who are not your spouse as your IRA beneficiary, there's a good chance they're going to fall into this category of IRA beneficiary. In the past, this group of beneficiaries was able to take advantage of something commonly known as the stretch, which is where distributions from inherited account could be spread over the individual's life expectancy. This allowed the tax benefits of the retirement account to last for as long as possible and keep taxable income each year to a minimum. Unfortunately, the Secure Act, yes, the same law from 2019 I keep bringing up, eliminated this tax benefit for regular designated beneficiaries. Now instead, this group of beneficiaries has to distribute the entire inherited IRA by the end of the 10th year after they inherit. This new 10-year rule isn't as bad as the 5-year rule that hits some of the non-designated beneficiaries, but it's a far cry from the decades that some children, grandchildren had to spread out the money before the Secure Act was enacted. Those of you who expect to pass on large retirement accounts to heirs should be particularly mindful of this change, and as it might influence planning decisions during your own lifetime, such as how much, if anything, to convert to Roth IRAs. The new 10-year rule, effective for most IRA beneficiaries and plan beneficiaries, began in 2020. Note, exceptions exist for governmental plans, collectively bargained plans, and certain qualified annuities where the lifetime income option was irrevocably selected prior to 2020. Finally, we get to the brand new type of beneficiary created by the Secure Act, eligible designated beneficiaries. Eligible designated beneficiaries are the only beneficiaries left who are, wait for it, eligible to stretch distributions using the rules that were in place before the Secure Act was passed. And as we discussed before, however, it's a pretty limited list and doesn't help many of you who plan to eventually leave your retirement assets to your adult children or other persons who don't fall into one of the above categories. And this is what it means to stretch IRA distributions. Eligible designated beneficiaries and only eligible designated beneficiaries are the only ones able to take minimum distributions calculated over their IRS-provided life expectancy. The stretch IRA then is just the name that practitioners have given to the strategy of beneficiary taking only the minimum amount out of an inherited IRA each year that's required by law. Doing so helps an eligible beneficiary to minimize their income tax and maximize the tax deferral on the inherited account. In contrast, all other beneficiaries typically have to withdraw all an inherited IRA money much sooner, as we discussed. Many people name their spouse as the beneficiary of their IRA, so let's talk about that for a moment. If your spouse is your sole IRA beneficiary, then he or she will generally have several options after inheriting your IRA. They include choosing to remain a beneficiary of your account, as well as making what is known as a spousal rollover. Let's talk about each of these in a little more detail. As I just mentioned, one option is the beneficiary is completing a spousal rollover. In a spousal rollover, the surviving spouse takes the deceased spouse's IRA and moves it right into their own IRA. A spousal IRA rollover is an irrevocable decision, and once completed, the funds are treated as though they were the surviving spouse's IRA. This is generally the best option for spouses who inherit an IRA at 59 and a half years of age or older. Another option available to spouse beneficiaries is remaining as the beneficiary of the inherited account. This is generally the preferred option if a spouse inherits prior to turning 59 and a half because it allows them to take penalty-free distributions from the inherited account regardless of their age. In contrast, if they were to take the spousal rollover, the money would be treated as their own, and therefore any distributions taken prior to 59 and a half would generally be assessed a 10% early distribution penalty. If you're a spouse beneficiary and you inherit IRA money prior to reaching 59 and a half, you can remain a beneficiary until you turn 59 and a half, and then at that time, execute a spousal rollover. In fact, more often than not, that's the best approach. There are other special rules that apply to spousal IRA beneficiaries, so it's always best to consult with a knowledgeable professional. With what we've come to our last Savvy IRA planning strategy, this one that you should all know about, but for whatever reason, people seem to forget, and that's to always do your homework before making any decisions with your IRA, especially when it comes to investments. IRAs are often the target of schemes and scams because, hey, let's face it, that's where a lot of people's savings are. I know it and you know it, but you know who else knows it? The scammers, right? In recent years, the SEC has alerted investors, warning that certain IRA owners that they may be a target of scams, and the IRS has even put out a publication with the title, "The IRS Does Not Approve IRA Investments," in response to many fraudulent promoters claiming that their IRA investments were somehow given the green light by the IRS. At the end of the day, it comes down to the golden rule. If it sounds too good to be true, it probably is. Your IRA may represent a lifetime's worth of work and savings. Don't squander it by making a foolish decision. Well, we've certainly covered a lot of ground today, and you should have plenty of food for thought. And as you probably realized at this point, IRA planning is a lot more complicated than most people realize. Let's face it, deciding what strategies are best for your IRA crosses into just about every area of planning, from tax planning to investment planning to estate planning. Few retirees are aware of just how critical IRA planning is, and even fewer have taken the time to truly evaluate all of the issues and develop a comprehensive solution. Hopefully, we've helped answer some of your questions for you today, but chances are you still have others, but that's okay. We are here to help answer your important questions, evaluate your current financial picture, and develop a savvy IRA planning strategy that's best for you and your family. Thank you again for joining me, and best of luck and continued success. You'll receive a follow-up email with an opportunity to register for a complimentary follow-up consultation. It's our way of thanking you for investing some time with us today. We look forward to seeing you at future presentations. Thanks again for attending. I hope you found this information helpful and interesting. Have a great rest of the day.